a conversation with us either through Twitter, tweeting us at Sky Business, or emailing us at yourmoney@skynews.com.au. But Julia, we have to start with that Rio result. It's an amazing state of affairs, isn't it, when you can be down 82% on the year before and the market gets excited. Julia, what was your take?
I guess if we have a look at Rio Tinto, we always knew that there was going to be a big fall because we have seen iron ore prices around about halving. We have a look at the underlying earnings result. The market was expecting about $2.7 billion and it's actually managed to beat. It's come in at $2.9 billion. It is still down 43% from the previous corresponding period, but I think there was a lot to celebrate in these results as well. Two of the key things that I was watching was the cost side of things and the capital expenditure side of things, and on both fronts we received some positive news. In terms of costs, for 2015 Rio Tinto was aiming to cut $750 million worth of costs, and in just half a year they've managed to cut $681 million. So around about 85% of what they were targeting. Not only that, because of that, they've seen an increase in their cost-cutting target to $1 billion. Now, capital expenditure back in February, we were told, was at about $7 billion. We've also seen that reduced down to $5.5 billion. So given the current state of affairs in the commodities market, where a lot of commodities are down more than 20% from their peaks, this is a positive thing for the company. We know that the dividend was expected around 108 US cents. It's coming at 107.5, so close enough there. So altogether, I think Rio Tinto ticking a lot of boxes. The shares were up 1.1% ahead of its results today, and I think the underlying result was above expectations. We've seen a beat on the cost side, and capital expenditure also revised down.
Michael McCarthy, I guess the mayhem on the stock market today wasn't actually directly hurt by it. We had ANZ, I guess, surprising some with this $3 billion capital raising. Its contemporaries being hurt in the process. We've got Commonwealth Bank down 3.2%. We've got Westpac over 3% and NAB down about 2%. What's your take on what this capital raising means, not just for ANZ, but for that banking space more broadly?
Carrington, first of all, this capital raising was a surprise to the market. 3 months ago, ANZ's Mike Smith was playing down the possibility of a capital raising, so we've seen an about turn there. So a surprise in terms of a capital raising by ANZ. And secondly was the timing of this capital raising, less than 1 week before CBA is due out with its full year numbers on the 12th of August, where the market was expecting to hear of how CBA was going to increase its Tier 1 capital with the possibility of a capital raising through a dividend reinvestment plan or the sale of assets. So the fact that ANZ has just snuck in there 6 days before CBA's result was due with a $3 billion capital raising. Now, it's quite a big capital raising. $2.5 billion is an institutional raising, and then $500 million through a share purchase plan. Now, the institutional raising is underwritten, so there is a floor in there at about $30.95, and it does look like it may get away around that floor. So that's a 5% discount to where ANZ last traded. And of course, the market now just discounting some of the other banks with the need for capital really at the front of its mind. CBA was down by 3.2% today. Westpac down by 3% and NAB down by 2.2%. Now, NAB managed to raise $5 billion, $5.5 billion back in May. We know that Westpac is doing this hybrid issue at the moment, so looking to raise $1.25 billion through that. And now Commonwealth looks like it needs to raise the most amount of money here because of the APRA regulations. So altogether, a negative for the banks today and some big falls in terms of the market. The other side of that was that we did see a trading update coming through from ANZ as well. The 9-month cash profit was at $5.4 billion. So that was only up by 4.3%, which was less than what the market was expecting. And if we have a look at, I guess, what was concerning the markets as well, provisions was up by 13%. Not so much because of the home loan market, but more because of what was happening in the mining and the agricultural space, where we have seen difficult times in those sectors. So a lot to absorb on the market, and I guess the banks were the main focus of the day, but unfortunately not a good one for Australian investors.
Julia Lee.